You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Carrie Lutz. Well, it's September 29th, 2021. You still got time till December 31st of 2021 to do some fundamental tax planning, whether you're an investor, business person, or wage earner, although as a wage earner, you have less flexibility. And we've got an expert with us here, Steve Moskowitz, attorney and accountant, who is going to guide you through the myriad of tax benefits that you can realize before the end of the year. Steve, it's great to have you on the show, and welcome.
The pleasure's all mine. Thanks so much for inviting me. And tax gets me really excited because, a lot of people will point to the Fortune 500 and say, hey, how come all those big companies are making billions of dollars in profit, billions with a B, and they're not paying any taxes? Because they do tax planning. And there's so much that the little guy can do too. For example, if you're in business or an investor, one of the things you want to take a look at is a retirement account. There's over 20 different types. And there's three major benefits. First, you get a big tax deduction. That usually in and of itself sells people right there and they say, terrific. But in addition to that, financially, as you well know, when the investments earn money, they're not taxed like if they were in a regular investment account. So your account can grow a lot faster, a lot bigger. And also, it has special treatment in federal law. It's what's known as an exempt asset. There's special protection. In business, you can get sued, and one lawsuit can wipe out a lifetime of earnings and savings, but they can't touch your retirement account. So if you have a judgment against you, they can take a lot of other stuff, but not your pension. And although I hate to mention his name, O.J. Simpson's the poster boy for this, because as you know, he's had a multi-million-dollar judgment against him for a long time, but O.J.'s not lost a penny of his pension. And even if everything goes really badly for you, even the bankruptcy court can't touch it. So if you wind up going bankrupt, you keep 100% of your retirement account. Wouldn't be the case with your bank account, stock account, or other accounts, but your pension account, very, very powerful. And there's other benefits too, even cash flow. Almost everything else, you have to do it by December 31st of year one to deduct it in year one. Mm-hmm. Not with the retirement account. With a lot of the retirement accounts, you get to set them up and fund them as late as the filing of the return plus extension. So in English, you get about 3/4 of the way into year two before you have to pony up the money, but you can still deduct it from year one. So that's a big, big benefit. For example, if somebody came into my office today, we could actually do it for him today and deduct it from his 2020 taxes. Then we take a look at being an entity. Now, what's happened is you want to be an entity for a lot of reasons. One is for asset protection, because if you have something in your own name, you can get wiped out. Let's have the example. Suppose that you're a landlord, and suppose you have 10 rental properties and you have them all in your name. And one night your tenant gets rip-roaring drunk, falls down, breaks his back, and sues you and say, I broke my back because you didn't have the floor in good condition. And the jury says, well, you're a landlord, so you're inherently evil, and we're going to award the plaintiff what he wants. Again, one lawsuit can wipe you out, but not if you're an entity. If you're an entity, the max the plaintiff can take is the equity of that one entity. Everything else, all your other entities, your personal assets, they're all safe. And then you take a look at state law, because you say, well, okay, I have 10 different entities. Do I have to pay 10 different fees to maintain them? It depends on your state, because some states will allow you to set up multiple entities so you have the asset protection but only pay one fee. And there's something else very important by having an entity. We know in the Tax Cuts and Jobs Act, it took away our ability to deduct state taxes in excess of $10,000 on our federal return. Nearly half the states have a workaround now where you set up an entity, you make an election to pay the state tax at the corporate level, not the personal level, then you get a credit. So you don't pay a penny more in state taxes than you would, but because it's a corporate deduction, you get to deduct it on your federal return. It's a workaround. That depends on state law, but almost half the states you can do that now. So that's another reason to be an entity. And also, although most things are designed for business, let's not forget our investor friends. Suppose we have somebody that's a wage earner and he or she has investments, or they're retired and they have investments. You might want to consider setting up an entity so you can have the workaround if that's available in your state. But also what you can do is set up a retirement account for this company that's going to manage your investments. So we know generally a retirement account is based on offsetting business income, not investment income. But because we set up a company to do the investments, now we are offsetting business income. And essentially when the smoke clears, it's as if through the use of the company, you have offset the pension contribution against your investment income. And that's just a touching on things. There's so many other things we can do.
Real quick, Steve, as far as the pension deductions, retirements, what's the maximum that you can deduct?
The beauty of it, there is no maximum. It's not like some of the plans, there's a flat, here's the maximum you can deduct. With what I call the fancier plans, like a cash balance plan, we have an actuary come in and do a bunch of calculations depending on your age, depending on the earnings, and a number of other factors. Our average client deducts a few $100,000 a year on these, and we have some clients deducting seven figures. That's the beauty of it. It can offset income. And another thing is that these plans are so flexible. Suppose you have an unusual year. You just have a beaucoup year, just a really big year. And you say, this is wonderful. I made all this income, but I don't want to pay beaucoup taxes. What can I do? With some of these plans, what we can do is go ahead, make multiple plan year contributions in one calendar year, and essentially have a gigantic retirement contribution in that year when you had the unusually large amount of money. So you don't just set these up, you monitor them and you work with them just like tax planning. Beautiful thing.
All right. So, hey, with that, at some point then you can terminate the plan and roll it over into a 401, not a 401k, a traditional IRA, a self-directed IRA, right? You can do all these things.
Don't just survive, thrive. The Financial Survival Network.
FPX Nickel is developing the large-scale Dakar Nickel District in central British Columbia. Within the district is FPX Nickel's PEA stage Baptiste nickel deposit, which is projected to be among the world's top 10 largest nickel mines by annual output. The Baptiste deposit has the potential for the lowest quartile operating costs at just $2.74 per pound. And compared to recent global nickel mines, the project requires a low capex. FPX is also commencing its first ever drill program at its Van target in the Dakar Nickel District. Surface samples have indicated that the Van target footprint is larger in scale and 10 to 15% higher in grade than Baptiste. FPX Nickel trades in Canada as FPX and on the OTC under FPOCF. To learn more, go to fpxnickel.com. That's fpxnickel.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
You could if you wanted to. Usually you wouldn't have a reason to do that, but if for some reason you wanted to, sure you could. Right. And then another thing we do, let's go back to our real estate investors. Mm-hmm. There's something called cost segregation analysis, which is very useful.
Very familiar.
Okay, so for our listeners that aren't, essentially what that does, it greatly accelerates your depreciation. And with time value of money, a benefit today is more valuable than a benefit tomorrow. And you say, well, okay, this is terrific. I can have the sweetest words in the English language are positive cash flow with a tax loss. And you say, this is wonderful. I have this rental building that I'm taking in more cash than I'm spending on expenses. I don't write a check to depreciation. It's just a paper entry. And now I've wiped out the profit from my business. But when someone gives you something nice, you want more. Give me more. Then the question is, if you have a paper loss from that building, could you offset it against your dividends, income, wages, profits from a business? The general answer under Internal Revenue Code Section 469, the passive activity loss rules, is no. However, there's an exception. The exception is if one of the spouses on a joint return, you only need one spouse to qualify, is a real estate professional. Then with a real estate professional, yes, you can deduct these losses. That's an area a lot of people miss.
Right.
And in a lot of cases, what you want to do is see, even if you're not a real estate professional, could we get one of the spouses to qualify? And this works exceptionally well when one of the spouses is a house spouse. And then you have this enormous tax deduction. So the bottom line is there's just so much you can do with your taxes. Then we have other things that we like to talk about, like R&D, research and development credits, where this is also beautiful because most everything else with tax planning, you do have to write a check for something, but you get a tax deduction, so that's good. Right. With R&D, you go in and you say, well, let's take a look at the money I've already spent this year, and you can amend 3 years back. And you say, okay, some of these activities that I've engaged in are qualified for the special treatment, R&D, research and development, and the government writes you a check for the current year and 3 years back. It's a beautiful thing. Speaking of the government writing checks, another one is a new one and very near and dear to my heart, ERC, Employee Retention Credit. This is essentially a government stimulus program for employers. The government, the federal government, will give you up to $33,000 per qualified employee. So if you had 10 qualified employees, you get up to $330,000. If you had 20, up to $660,000, and so on. And the bottom line is, it's a grant. It's not a loan. It's a government giveaway. It has a lot of advantages. If you're familiar with PPP, it's not like that, because PPP, the big problem was the government set aside a sum of money and said, have at it, first come, first serve. But when the money's gone, the program's over. ERC, it's U.S. Treasury. There's no limit. And that's a very beautiful thing. Also, you don't have to ask for forgiveness. You don't have to spend the money in a particular way. You just go ahead and you get this government grant. So the bottom line is you really want to look at this. And I'm going to suggest, don't try to determine if you qualify on your own. Go to your tax professional. And the reason I say that, this law has changed and changed and changed again. And at the time of this podcast, it's still changing. And what that means is on the internet, if you go to Dr. Google, there's an awful lot of information out there that's old, and this stuff has changed very quickly. And under some of the older rules, there was a lot of people that didn't qualify. And now a lot of those same people do qualify because every change has been more inclusive. And one of the things where I see this all the time in practice, people call me for all kinds of things. And I'll say, hey, what about ERC? And, oh, no, I checked and I don't qualify. So, well, humor me. Let me ask you a few questions. And they do. And guess what, Kerry? To date, I told you I've had a lot of people that thought they didn't qualify, but they did. But to date, my biggest one was a client who qualifies for almost $2 million. Wow. Had he not happened to call me for something totally different, unrelated, he would have turned his back on almost $2 million. I mean, yeah, can you imagine?
Mm-hmm. That's amazing. Well, that's just a few of them. I'm sure you got a lot more where they came from. Steve.
Absolutely.
And how about if you tell us how we connect with you on the web, how we can get a consult with you? I assume you can help people in any state, anywhere in the country?
Anywhere in the country or anywhere in the world. Not only do we have clients all over the United States, we have them internationally as well. Either call us at 888-TAX-DEAL. That's 888-TAX-DEAL. That's 888-TAX-DEAL. Or MoskowitzLLP.com, MoskowItzLLP.com, or 888-TAX-DEAL.
All right. Excellent. And there's a link to that in the show notes. Or you can send me an email to kl@kerrylutz.com. I'll make sure it gets to Steve and you get an answer. And don't forget to sign up for our free newsletter at financialsurvivalnetwork.com. Steve, been a real pleasure, very enlightening, and we'll be talking to you again.
Thanks so much for inviting me. I really enjoyed it.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.